In 2026, trading represents a fundamentally different system from how it is commonly perceived. While it is often portrayed as a way to make quick profits from price movements, in reality, it is a highly competitive environment built on technology, data analysis, and risk management. Formally, trading is the process of buying and selling financial instruments in order to profit from price changes. In practice, however, it has evolved into a system where the key factor is not prediction, but information processing and statistical advantage. Modern trading is working with probabilities rather than predictions. Modern trading is exploiting short-term market inefficiencies. Modern trading is strict risk and capital management. Modern trading is competition between algorithms rather than individuals, and thus profitability is driven not by intuition but by systematic execution. Financial markets in 2026 are a multi-layered system of participants. The primary role is played by institutional players, whom investment banks, hedge funds, and market makers provide liquidity and shape price dynamics. The defining shift in recent years is the dominance of algorithmic trading. A significant portion of transactions is executed automatically using execution algorithms, high-frequency trading strategies, and machine learning models. These systems analyze markets and execute trades in milliseconds, making it extremely difficult for individual traders to compete. Retail participants, despite their growing numbers, generally do not drive the market but react to movements already created. Market price is not a reflection of fair value but the result of supply and demand imbalance, order book structure, and algorithmic activity. Algorithms often act as liquidity providers, placing buy and sell orders and profiting from micro-movements. This means price movement is not a simple reaction to news or fundamentals, but a complex outcome of multiple interacting systems. The foundation of any successful trading approach is a strategy with entry, exit, risk, and position rules, and without a defined system, trading becomes random and statistically leads to losses. There are several core profit models, including speculative trading, arbitrage, and quantitative strategies. Time horizons range from milliseconds for high-frequency trading to months for position trading. Technological accessibility has lowered entry barriers with modern platforms, mobile apps, and APIs. Media and marketing create an illusion of simplicity that hides the high rate of participant losses. The expansion of cryptocurrencies and derivatives has attracted new participants seeking high returns. Social media amplifies herd behavior and the fear of missing out. Accelerating inflows of new traders, algorithms are displacing humans in short-term trading, and most obvious investment ideas fail. Markets have become more volatile and reactive, and a significant portion of retail participants loses capital. Examples include post-IPO price declines, sharp corrections in crypto markets, and volatility spikes caused by automated systems. In 2026, markets are algorithm-driven, highly competitive, and require a systematic approach for success. Reduced predictability means markets rapidly respond to macroeconomic and geopolitical factors. Modern trading is not a shortcut to wealth, but a complex professional activity at the intersection of finance, mathematics, and technology. It can be defined as a system of competition between models, capital, and speed of information processing. The growing number of participants is driven by accessibility and popularization, but this does not reduce market complexity. Sustainable performance is only possible with a clearly defined strategy, strict risk management, deep understanding of market structure, and disciplined execution. Without these elements, trading ceases to be a controlled process and becomes a form of speculative risk with a high probability of loss.